At exactly 9:30 a.m., a phone rang inside J.P. Morgan Chase headquarters on Madison Avenue. On the other end wasn't a client. It wasn't a regulator. It was a margin clerk from the CME group. The message was simple and catastrophic. J.P. Morgan was required to post $4 billion in immediate liquidity to cover mounting losses on its silver short positions. Under normal circumstances, this is routine. A wire is sent. The clock resets. The game continues. But today, the wire never came. 10 o'clock passed, then 10:30. By 11:08 a.m., whispers began moving across trading desks, quiet at first, then urgent. The unthinkable possibility was being spoken aloud. The world's largest bullion bank had missed a margin call. We can now confirm what Wall Street is terrified to admit. J.P. Morgan failed to meet its capital requirement. For the first time in American financial history, a too-big-to-fail institution had technically defaulted on its obligation to an exchange. The king didn't stumble. The king fell. To understand why this moment has frozen Wall Street in place, you need to understand what a margin call really is. When a trader uses leverage, they are borrowing money to place a bet. The exchange requires a cash buffer, collateral, to ensure losses can be covered. When the trade moves against you, when silver rockets to $85 an ounce, those losses eat into that buffer. When it's gone, the exchange calls. Pay within the hour, or control of your positions is taken away. Everything is liquidated. No discretion, no negotiation. J.P. Morgan, the bank holding the deposits of millions of Americans, just admitted it didn't have the cash. How does a bank with trillions in assets fail to raise $4 billion? Because they don't hold money, they hold assets, illiquid real estate, long-duration bonds collapsing under rising rates, opaque derivatives marked to fantasy prices. This is the dirty secret of fractional reserve banking. They are asset-rich on paper and cash-poor in reality. When silver surged, J.P. Morgan's liabilities exploded at the exact moment its bond portfolio imploded. Rising rates crushed the value of its collateral, while its short exposure detonated. They were trapped. And in a margin call, only cash matters. This missed payment wasn't a delay, it was a confession. Because the call was missed, the CME is now legally obligated to liquidate J.P. Morgan's positions. The exchange's systems don't debate, they don't negotiate, they execute. Algorithms begin buying silver, at any price, until every short contract is closed. This is the ignition point. This is the forced buy-in we warned about. Billions of ounces of paper silver are now being chased by machines that Don T care about valuation, only survival. When a short seller defaults, the long holder wins by default. And J.P. Morgan is not an island. They are the counterparty to everyone. If they can't pay Bank of America can't pay Citi. If Citi freezes, the system freezes. This is counterparty risk, and it spreads at the speed of trust collapsing. Overnight lending rates are already spiking. Banks are pulling liquidity. No one lends to a corpse. This is exactly how 2008 began. And right now, inside the Federal Reserve building in Washington, an unscheduled emergency meeting is underway. Helicopters on the roof, doors closed, decisions being made that will define the dollar's future. They have two options. Let J.P. Morgan fail and take the global economy with it, or print trillions by tonight to keep the casino alive. And if they choose the printer, the currency dies, so the system can pretend it didn't. The question now isn't whether the Federal Reserve intervenes, it's how much damage they're willing to inflict to stop the panic. A missed margin call is not a private problem. The moment it happens, contagion begins. It spreads through clearinghouses, repo markets, and derivatives desks at the speed of collapsing trust. J.P. Morgan is the central node of the system. They sit at the center of global finance, trillions in deposits, tens of trillions in derivatives. When they fail to perform, payments don't arrive. Obligations stall. Confidence evaporates. And confidence is the only thing holding this system together. Within minutes of the missed call, stress appeared where the public can't see it. Overnight funding rates jumped, interbank lending thinned, liquidity vanished. Banks stopped returning each other's calls. Because no one lends money to an institution that may not survive the day. This is how freezes begin. Inside the derivatives complex, alarms are now flashing. J.P. Morgan holds over $50 trillion in notional derivatives. Rates, currencies, commodities, energy. These contracts require constant settlement. If one party fails, the clearinghouse absorbs the loss until it can't. This isn't about $4 billion. It's about the signal. It tells the system the largest player is operating on fumes. As rumors leaked, silver reacted violently, not because of fundamentals, not because of demand, because the market understood something crucial. There is now a forced buyer. The exchange must buy silver at any price to close J.P. Morgan's shorts. Algorithms don't negotiate. Hedge funds know this. High-frequency traders know this. They are front-running the liquidation. This is a gamma squeeze. Price is no longer set by supply and demand. It's set by desperation. And this moment wasn't accidental. China didn't stumble into it. They accumulated physical metal while the West played paper games. They drained vaults. Then they allowed prices in Shanghai to rise, knowing exactly what that would do to short positions in New York. No missiles, no sanctions, just leverage. Now the dominoes fall. If JP Morgan can't pay its counterparties, those counterparties freeze. Clearinghouses step in. Then governments. This is how a single default becomes systemic. Expect calming language from officials. They won't say default. They'll say technical delay. They'll say liquidity issue. They always do. They said it in 2008, right up until the system broke. Meanwhile, bail-in laws remain quietly in place. Under Dodd-Frank, depositors are unsecured creditors. In a resolution event, deposits can be converted into equity. You don't lose your money, you lose control of it. JP Morgan is custodian to trillions in pensions, retirement accounts, and corporate cash. If accounts freeze, payrolls stop, supply chains break. This is how a banking crisis hits the real economy. Comics will try to contain the damage. They'll suspend deliveries. They'll offer cash settlement instead of metal, printed cash. And printed cash after this is worth less every hour. That's why the scramble is happening now, before announcements, before bank holidays, before the doors close. Because once the system locks, digital wealth is trapped. This is the transfer, from promises to possession, from paper to metal, from trust to reality. At 9:30 a.m., the illusion cracked. By midday, the system knew. The reset didn't arrive with an announcement. It arrived with silence. If you can't hold it, you don't own it.